Hi, welcome back to Chapter 11. We're going to work a lot with stock transactions, corporate organizations, dividends, and retained earnings. Major characteristics of a corporation. Forming a corporation, stockholders' rights will be covered in this first video. So let's look at this. What is a corporate form of an organization? It's an entity separate and distinct from its owners. And this is a really big difference between the corporation and other forms of businesses, such as partnerships and sole proprietorships. So you can be classified by purpose and you can be classified by ownership. So under purpose you can be for profit, such as Wendy's, such as the Mars Snickers, the company that makes Snickers and M&Ms. You can be not for profit, like the Bill and Melinda Gates Foundation, the Susan B. Komen Foundation, and Hope Inc. You can be classified by ownership. You can be publicly held or privately held. Now there's some fairly distinctive characteristics that we're going to walk through regarding corporations. Most of them are advantages, but there are some disadvantages. They are a separate legal existence. This is an advantage. The corporation is separate from the stockholders. There's a big solid line between them, and that line relates to financial transactions. So I own stock in Paquette. If highly unlikely, but if the Paquette company were to go out of business, go bankrupt, yes, I might lose my investment. But the debtors, the creditors of the Paquette company would not come after me personally. That's a huge difference. And the word corporation itself comes from the Latin word corpus, or body. It's an artificial entity. Limited liability. I kind of alluded to that in the last slide. Stockholders are only at risk to the extent of their investment. I could lose all my stock value, but I would not lose my house, my car, my savings if the corporation went under. Transferable ownership rights. This is an advantage. It's easy to buy and sell stock. For publicly held companies, everything's very public. You can just trade the stock easily. It is not required to get consent of other owners to sell stock. This would not necessarily be true in a partnership. Ability to acquire capital. How do we get our money into the company? It is a lot easier to obtain capital through the stock market or through the bond market, as we saw last chapter. And investors can be really big corporate investors, or they can be really small. It's not as easy to raise capital in a partnership or sole proprietorship. And corporations have a continuous life. If I die, the stock that I own in Paquette would go to my next of kin, my family, or whoever I willed it to. A corporation is not limited by the life of its owners. And there are exceptions to this, but in general, corporations live on indefinitely. Another advantage, corporate management. Having professional managers is an advantage. You hire people who know how to run companies, who know how to work in purchasing or human resources or operations, manufacturing, service, and sales. Now, that's an advantage, but if you have professional managers who are not owners, that could be a disadvantage. Why? Maybe they don't care personally as much if the company is successful or not. They're a little bit mercenary, just working for the company. So the question always comes up, should managers own stock? Would owning stock make them more invested in the company? And there's a strongly held belief that yes, if they're part stockholders, then yes, they will be even more motivated to make the company successful. Let's look at this organization structure. Characteristics of a corporation, and this one actually is out of your book. So here we go. We've got the stockholders who own the company. You've got the chairman and the board of directors. You've got the president and CEO, and sometimes that person in the pink box is the same person for smaller companies. And then underneath you have major departments, major areas. You've got general counsel and secretary, you've got marketing, sales, you've got the whole finance group, you've got human resources, and you've got operations. I always like to ask students, there's something pretty, operations would be, for Starbucks, that would be the roasting plants, the Starbucks stores, everything it takes to get the product, the core objectives of the company to the customer. Now, I always like to say to students, there's something missing from this chart. Can you think what it is? Take a good look. There's no research and development on here, and research and development is a really, really important part of a company. Government regulations, huge disadvantage. You know, lots of rules, lots of laws. You've got the New York Stock Exchange, NASDAQ, the American Stock Exchange. You've got lots of federal and state laws that companies must comply with, and of course the whole IRS tax code. Another disadvantage, additional taxes. Now, corporations pay an income tax. That's tax number one. Stockholders get paid dividends from the corporation. Stockholders who own the corporation are taxed on their dividends. And as of right now, corporations are not allowed to deduct dividend payments. So they have a bunch of stockholders, they pay them dividends. They cannot deduct dividends the same way they might deduct interest expense on bonds. So let's form a corporation. What are the first steps in doing this? We have to file an application. The company has to file an application with the Secretary of State. So here it would be Washington State. Washington State grants a corporate charter, and then the corporation develops its bylaws, its rules that it follows. Now, just because you work and have your main offices in Washington State does not require you to incorporate in Washington State. So many companies incorporate in states that are more favorable, Delaware, New Jersey. So when you are forming a corporation, you are allowed to expense organization costs as they are incurred. Now, this is kind of an interesting concept because usually we would say, no, you can wait on that because after all, those expenses have benefit the corporation for the life of the corporation. But no, we would say the rules are such that they are to be expensed up front. Stockholders' rights. Stockholders have the right to vote in elections of the board of directors and on actions that require stockholder approval. So for every share of stock that you own in a corporation, you get one vote. And they also have the right to share in the corporate earnings through dividends. Now, another right is called preemptive rights. If the company issues new stock and you own 14% before they issue new stock, you have the first right of refusal. What that means is they will turn to you and say, if you want to keep your 14%, you need to buy so many more shares. And they have to let you have that opportunity to buy first. A number of companies have eliminated the preemptive right, and that would be a feature in your bylaws. Stockholders have the right to take a share in the assets upon liquidation in proportion to their holdings. So translated, that means if the company goes bankrupt, if there's a certain amount of money left over that will be shared only with the stockholders, whatever percentage ownership you have, you will get that percentage share. This is called a residual claim. Now remember, stockholders are paid last, not first, when a company goes bankrupt. This is an old-fashioned stock certificate. It's pretty old. I think the date there is 1994 is a date stamp up in the left-hand corner for the John Wiley Company, which is the textbook we're using. They have lots of, this is a Class A common stock. They have, you never see these stock certificates, although you are legally allowed to request them. Most companies just work with a broker and the stocks are tracked electronically. But it's always fun to look at an old stock certificate. So you got the class, Certificates are pre-numbered. You've got the name of the corporation. Stockholder's name is on there, and number of shares, and the corporate official signing it. Alright, I would like you to take a look at the self-study questions 1, 2, and 3, and the solutions are at the end of the chapter. Let's move on to part 2.